Welcome back. We're just counting down to the pre-opening right now, and looks like it's going to be a good start. You just heard from the management of SBI about how corporate capex is picking up in a big way. Sanjeev Bhasin is sitting by with us. Sanjeev, I know we discussed SBI before the break, but after hearing the management, you get a sort of enthusiasm because they said that there's a big pickup that they're seeing in corporate capex. There's 12 lakh crores worth of fresh corporate investments in the first half of the year. At this price of 580 on SBI, how does the risk-reward look for a long-term investor?
Well, like I said, the most hated sector in the last 2 years was PSU banks, and now this has been the best performer. And still we think that some of the mutual funds are most underweight on PSUs. Everyone has been scrambling about the private bankers. I still think that the surprise can come on the upside. And as a coverage, we have both State Bank, Bank of Baroda, Can Bank. Union Bank is my dark horse, but the star will be PNB. The new chairman says that cash is at the highest level they've seen in their book, and their lending is at the best. So take it with a big pinch of salt that if Mr. Khare is saying that capex is around the corner in a big way, then that's a very, very bullish undertone. Also, Sonia, let me allude, you just mentioned Mr. Murli is coming. 8.5, 9 was my top pick of South Indian Bank about a month back. The stock has hit a new high of 14. I still think there is room on the upside of 18 rupees. It's turned profit. It came out with a profit of 233 crore after, I think, almost 12 quarters. So I think banks are in a very sweet spot. On a personal note, my top pick over there is IndusInd Bank, given that it is the largest player in the commercial vehicles. It is the largest player in the diamond trade and in the MSME. And the management is guided about a 20-22% growth rate, well ahead of most of the other competitors. So I think IndusInd fits the bill to be a new high stock in the coming month.
Okay, all right. On that optimistic note, we'll thank you, Sanjeev. Thanks so much for stopping by. And do stay tuned, though. We'll have the chat with the South Indian management, bank management, which you had recommended at much lower levels. And as you said, it hit a 52-week high. Well, let's move on then. We have Ashish Chaturmutta, Director, Head Research at JM Financial, who joins us. Hi, Ashish. What do you have for us today?
Hi, good morning, Nigel. Broadly, if you look at the broader markets, we are continuously sustaining above an important resistance point, which is around 17,500. And looking into the broad trajectory of the market, it looks like we are headed towards 18,100 kind of trajectory. So keeping that in mind, we have all long calls. Basically, we are focusing on the auto basket, and we like Maruti, which has been consolidating for a while and has given a fresh breakout in the last trading session about 89.50 trajectory. So that was a strong resistance zone. And keeping 88.50, I think Maruti could be initiated as a long idea. We expect the stock to hit 9,300 in the immediate short term, and positionally we are looking for an all-time high levels to get retested, which was around 9,900 kind of zone. Second buy call is again on the auto basket, which is Mahindra & Mahindra. Again, this stock has been consolidating between 1250 to 1290 trajectory. Now it looks like we have seen a very strong consolidation and a strong Y build up in the stock. So keeping that in mind, keeping 1260 as a trading stop loss, one can initiate a long position in Mahindra & Mahindra. On upside, 1340 would be my shorter term target, but positionally, we expect a stock to hit 1450 kind of trajectory in next couple of weeks. L&T is looking very strong, Nigel, and this is one stock from the capital goods space, which is showing very, very strong trend after a good consolidation. So here one can initiate a long, keep 1915 as a trading stop loss. On upside, 2050 would be my short-term target in L&T. And PSU Bank, so as you are discussing, it looks very, very promising. The entire basket and index is looking very positive. In the cash segment, we have been recommending our clients to go long into the Nifty PSU Bank ETF, which is available at around 38 levels, where we are looking for a positional target of 45. But since it's not available in FNO, so the stock which we are focusing in the FNO segment is State Bank of India, where one can initiate a long, keep 568 as a trading stop loss. On upside, 610 is our short-term target in State Bank of India.
All right, Ashish, we'll leave it at that. Thanks a lot for joining in. Well, as promised, we have the South Indian Bank management that's joining us now. The stock is at a fresh 52-week high. It saw a 12% up move after its earnings and is up 40% in the last 1 month. Very strong set of Q2 numbers. Margins expanded to a 30-quarter high and loan growth was also robust. Murali Ramakrishnan, the MD and CEO at South Indian Bank, joins us now. Mr. Ramakrishnan, good morning and thanks a lot for joining in. Very strong numbers this time, but give us some guidance. How does the way forward look? In the second half of the year, what kind of realistic loan growth are you looking at? And by the full year, where do you think you'll end?
As I said in the past, I think what we are experiencing is double-digit growth as of now, and for the full year also, probably I would tend to put the numbers as 12 to 13% kind of growth for the full year. Conservatively, if things pan out well, I'm sure it can be a little more than that. So that as far as asset growth is concerned, as far as the NIM is concerned, my guess is that we are currently, for the quarter, we are at about 3.2%, and for the bank as a whole, we are at about 2.98, close to 3%. Probably I would continue to feel that it will be inching up to maybe 3.1% kind of numbers for the full year, because we are expecting that liquidity and the way the loan growth, both we'll have to closely monitor as to how we play out these things.
Okay, that's important, sir. You're saying, good morning, Mr. Murali. You're saying that NIMs could come under pressure. You will have to raise deposit rates. Is that what you're saying?
I would say that it's actually NIM has always been under pressure for a bank like ours. If you look at, we are actually competing with the large set of banks and several medium set of banks. So NIM is always something which we are extremely cautious about. So it's clearly we'll have to at the kind of assets which you are onboarding and the kind of liabilities which you are raising, both will have to make a lot of sense. That's the reason why, if you look at our liability growth, I've been continuously saying that we've been consciously growing our CASA, which has grown to almost 34.5% now as of Q2, and which used to be, if you recall, a few quarters back, it used to be below 30% level. And if you look at deposits also, in term deposits, bulk deposit is something which we have been degrowing because it was high cost deposit for us. And that, I think almost the work is done now. Now, from now on, probably we'll be looking at very closely in what bucket do we need to raise deposits and how we deploy it.
I was going to ask you that. Actually, the 1 or 2 points of worry in your results, an otherwise very good set of results, is that deposit growth is only less than 2% year on year and only 0.3% quarter on quarter. Is the degrowth of bulk deposits over now? Can we expect better numbers?
Yeah, it's almost over. Still, we have about a couple of thousands of crores of bulk deposits. We will continue, but given the fact that now the inflation is high and the deposit rates are on the higher side, probably it might make sense not to play it down too much. Probably we'll continue to keep them, and we'll continue to see how we can overall bring down our cost of deposits.
Okay.
That's.
All right. Hi, Mr. Ramakrishnan. The street is clearly enthused. The stock price has moved big time. So we'd like to know further details. I believe your corporate loan book as well. From March itself, it's shown some traction. I believe it's up more than 20%. And you're lending to better rated companies as well, is what I gather. So putting that into perspective, if you could give us a couple of numbers on the credit cost, annualized credit cost, what is it likely to be for this year? And also on the slippage ratio, what is the rough range you're working with?
Slippage, we're expecting continue to be around, let's say, 2% kind of levels. And credit cost, probably I would put it at about 1.25 to 1.3%, which is far lower from what we used to experience in the last 7 years.
So, Murali, another outstanding number besides the rise in margins, related number is the cost to income. I mean, 56.6 is high perhaps by other bank standards, but you were at 82. That's coming down to 56 is excellent. Is there more room to bring it down? Any number you're working with? Because those are at least costs you can control.
Yeah, of course, the target for cost income, as I've been saying, is for the best banks, it's at about, let's say, 45% kind of level. For a bank like ours, the first benchmark probably would be 50%. We need to bring it down below 50%. But the best part of it is, the cost income, as it's very obvious that the more your income keeps going up, your ratios start playing out. So the fact that our new book, I mean, the whole background of the whole thing is that the new book which I've added from October 2020 onward, that's when I took charge as MD. We have added about 34,000 crores of book in which I have NPA of less than 10 crores. So it's about 0.2% is my NPA in my new book. So if I continue to churn my portfolio, you will clearly see that my provisioning numbers will start majorly from whatever current levels are. Naturally, it will impact, it will positively influence my profit, net profit. I am fairly confident that with the way now the behavior changes happened in the team and the way we are now sourcing and underwriting, I am fairly confident that the 50 is clearly the first benchmark, and I'm sure try to move towards the way the best banks are run today at 40%.
Okay. Just coming back to loan growth, right? You did mention that 12 to 13% is your target for the full year. We were just speaking to SBI, who told us that there's a big comeback in corporate capex now. So for you, between retail, a large chunk, of course, for you comes from retail, from gold loans, etc. But between retail and corporate, where are you seeing maximum traction? And are you also seeing a return of corporate capex?
No, actually, contrary to what you're saying, our growth has actually come from corporate. If you look at our delta advances growth, it has come predominantly from corporate. And corporate also, it's a combination of, I would say, both short-term as well as medium, long-term kind of facilities. See, if you had to really look at what was happening in corporate is that till about a year back, they were able to raise funds at a much, much lower cost in the international market. And now with the way anyway inflation has gone up in many of the countries, record inflation for many decades, clearly for them to have increased working capital extra, they're looking for domestic lenders to lend. And that's where we are also seeing good traction happening. And also, thanks to COVID, we all had quite a good amount of surplus with us, and therefore it was helping us to get traction with the good rated corporates. I mean, my incremental corporate banking book has got 90% of my incremental addition is A and above cases. I mean, they also have, except for one account in B and one account in BB, rest all triple B and above, and predominantly it is A and above. And wherever you get, start actually working with them very closely for all their working capital needs and capex needs. So that's where we are getting.
Got that, Mr. Ramakrishnan. Thanks so much for stopping by. NIMs at around 3.1%, loan growth of around 12 to around 13%, lowering of credit costs as well as slippages. You've given us those numbers. Good speaking to you. For the time being, the stock is up close to 2.5%. Let's go back to Sudarshan, who's waiting by. Sudarshan, what's... okay, let's go to Mitesh first. Mitesh, what's the 9-10 call?
Nigel, I think I will go with the buy on HDFC AMC. Keep the toggle at 2035 and 2130, 2140 should be the first target range.
Okay, got that. Sudarshan, if you can hear us now, what is your 9-10 call? And also my congratulations, you're right that PSU banks are not the biggest rallying today. Kotak Mahindra Bank is the one that's doing it. Anyway, your call.
Well, you should be long in the Nifty and the Bank Nifty. And L&T is a buy with a stop under 1891.
Okay, all right. Thanks a lot, Sudarshan, for that. The stock of the moment on the downside is Chennai Petro. It's down almost 15% in pre-opening. Sonal was telling us about how the margins, there's a big fall in the GRMs this time around. So that's going to be a big loser today. But Ekta is also standing by to talk about Gland Pharma and Glenmark and why she's watching that. Ekta.
Thanks for that. Well, yes, I'll start with Gland Pharma. That stock is going to be in focus on account of its numbers. And it was a disappointing set of numbers, at least in terms of the margins for Gland this quarter. Revenue was down 3%. Yes, the street was anticipating around a 9%. Revenue was down 9%. The street was anticipating a 9% decline. It was down 3%. Margins 28.4%. Street was anticipating around 31 to 32%. And the profit estimate was lower also. The street was anticipating around 250 crores in terms of profit. So while there was a Q-on-Q recovery, the year-on-year performance was a bit subdued, at least especially in terms of the margins. Core markets, which is 75% of the business, was up 3% year-on-year. India was down 42%. Remember, it was down 70% last quarter as well. And that was because of reasons such as a high base, supply issues that the company was facing. But what is supporting the stock is the net cash continues to remain high, plus as well as the valuations, considering that the stock is already down 45% from its 52-week high. Brokerages such as Bernstein, Goldman have cut their target price. Jefferies has downgraded the stock to hold. Now, Glenmark is in focus because their Baddi facility has received an import alert from the US drug regulator. So that is negative news. While Baddi does not contribute that much in terms of US sales, 1 to 2% in FY22, the overall sentiment is negative for Glenmark, considering that it is going to be a long road ahead for them to resolve this import alert. And generally, Glenmark has always had a very strong regulatory track record. So this would definitely be a chink in their armor.
Oh, that point is taken. Thank you very much, Ekta. The other stock which should be on your radar should be Dabur, not only for the results, but of course for them spicing up with Bacha. Mangalam, give us all the details you have.
Well, not so much for the results. Dabur will definitely be in focus on account of the Badshah acquisition. They've gone ahead and acquired 51% in Badshah Spices for about 587 odd crores. This values the company a little over 1100 crores. 49% of the shareholding will be acquired in 5 years from now. The deal is done at just under 5 times FY23 earnings and 20 times FY23 EV to EBITDA, which means that Badshah works at a 23% margin with 256 crore in terms of sales. But that's not as important as the fact that 82% of their sales come in from blended spices, which are a high gross margin product. And secondly, this makes Dabur's entry into the 25,000 crore organized branded spices market, which is growing extremely fast. And importantly, what Dabur can do with their distribution scale is something we need to watch out for. The company said that this will be EPS neutral in their first year and accretive from year 2. Dabur as a stock should also be in focus because after they've given their second quarter update, which was weak, the stock is corrected about 15% and it's trading at around 40 times FY24 earnings, which is at a bit of a discount to the sector as well. Goldman Sachs has written on this. They've said that this acquisition will significantly boost their kitchen condiments ambition, which the company has about 500 crores in terms of a target for. And the key risk, however, is a sharp slowdown in rural demand as well as some competitive intensity in the health foods category. Be that as it may, they're positive on the stock with a target price of 680 rupees.
Okay, thanks for that. Getting me a bit hungry there, but the market is opening, so we have other things to focus on. That's the first tick on the index. Good opening for the Nifty, up about 120 odd points. The mid-cap index is up almost 0.3%, and the Bank Nifty is surging away, 300 points higher now on the Bank Nifty. Top earners go to the metal stocks this morning. Hindalco, JSW Steel are your top gainers. Tata Steel not too far behind, up about 1%, so keep that on your radar. Followed by the banks, Kotak Mahindra Bank and financials, Bajaj Finance, you have IndusInd Bank, heavyweights like Reliance Industries. So there's a comeback from a lot of the heavyweights this morning. Titan is the other one, up about 1.5%. In fact, a couple of these names like Coal India, which have been big monthly gainers, Coal India is up almost 15% this month, is up an additional 0.5% right now. Similar is the case with SBI. Very strong commentary from the management. The stock is up almost about 0.5%. It's up 10% in the month of October. What's not doing well? SBI Life is under a bit of pressure. Power Grid, NTPC, Infosys coming in for a tad bit of profit taking, and Axis Bank just mildly in the red. Otherwise, it's a very good opening for the market, and the advance decline ratio as well is well in favor of advances, almost 1,800 stocks. It's metals once again that are taking top honors, and HDFC is your top gainer. But lots of traction in mid-caps as well.
Well, that's right. So now, metal index is doing well because the dollar index has cooled off, and NALCO as well in particular. Aluminum prices have moved up overnight. So that seems to be having a bit of a rub-off effect. Besides that, Dabur is up. It's reacting to that acquisition. You have a couple of other names as well that deserve special mention. Gland Pharma, the numbers are disappointing. The stock is down close to 5%. Crompton's numbers as well, the growth parameter, they were lagging as well in the ECD business. So that stock as well opened up with a cut of around 2%. It's recovered a little bit. We had the management of South Indian Bank that just joined us, and they were sounding very, very optimistic. So that stock continues its upward trajectory. Remember, just a couple of months ago, it was it was at 9-10 rupees odd. Now it's at around 13 rupees or thereabouts. And a couple of other names, Unsold Properties, stock is up close to around 5%. Piramal Pharma, remember post-listing, the stock saw a one-way decline. It was hitting constant lower circuits with 5% lower. Now, in fact, it's holding with a cut of around 1% or thereabouts. So let's see whether or not bulk of that selling has already got absorbed. Lata.
Okay. Point taken. I mean, you've covered ground. I just wanted to point out two unexpected candidates who are at 52-week high, Cipla and Sun Pharma. 52 highs for the stock. So just Pharma getting a look in.
Just one more, Lata. Nykaa. We remember the kind of excitement we had when it was listed.
Yeah, the lock-in is over.
It's back down to the IPO price now. 1,100 rupees, fresh 52-week low on that one. So keep an eye out on that one.
I think 10th November is when the lock-in expires. So then post that, there'll be so much more supply kicking in perhaps as, the large shareholders sort of choose to exit.
That's right.
Yeah, so that now we know that where the pudding has to be tested the day after lock-in. Chennai Petro, a very important stock again to watch. The results were very, very unflattering. Stock is down, what, 13%? There to come up for you. There it is. Not looking good. But where are we headed in the medium term? What do we buy? Is this rally already too hot for us? For all those questions, Hiren Ved, the CEO, Director and CIO at Alchemy Capital Management, joins us now. Hiren, good morning. Thank you very much for joining us on what's a very important week, festive week for us. So festive greetings to you and your family as well. Have a great Samvat 2079. But tell us what the market can do. Are new highs just round the corner, or are we already a bit too hot to handle?
Well, Lata, to begin with, a happy Diwali and a happy New Year to you and everybody at CNBC-TV18 and all the viewers as well. Well, Lata, I mean, I have no doubt that we are very close to new highs, and you could hit new highs, sometime soon. I think Indian earnings have been reasonably good. And I think India is on a fairly good wicket, both when it comes to macro and micro. And as I've always been saying, the Indian market is behaving like a strong stock. It corrects less when global markets correct. And at the first signs of stability, we kind of take off. And I don't see that changing dramatically, unless obviously, for whatever reason, if oil prices go up, that's something that we need to worry about. But that doesn't seem to be a worry at this point in time as well. So I think we are on a fairly good wicket, and we continue to be very, very positive on the Indian markets.
Okay, very positive on the Indian markets here.
And new highs around the corner.
Yeah, I think that statement has been echoed by a lot of our experts who've come in, right, through the course of Diwali. Hiren, greetings of the season to you. I want your thoughts on PSU banks, because anyone and everyone is now starting to get positive, and we have a lot of bullish commentary coming in from the largest bank, SBI, just a while back. Do you only stick with SBI, or do you move outside? Because many of these banks have had a great trading rally in the last couple of months. But is it just that, a trading rally, or should investors look here as well?
So I think, Sonia, the entire banking space has done phenomenally well. And to be fair, I think the public sector banks have led from the front, because their balance sheets were never this clean. And this time, everybody's starting on the same starting line. So whether it's the public sector banks or the private sector banks. And there was also a valuation cushion as far as public sector banks were concerned. And therefore, I think in this market, where it's tough to find value, where earnings are growing, clearly public sector banks is one area where there was both value and growth. And therefore, we are seeing the kind of performance that we are seeing in the public sector banks, right? Also, I think given where we are, if there is one read-through from all the financials results that we've seen so far, obviously credit costs have been very benign, credit growth has picked up. But I think soon, in a quarter or two, there will be a fight for deposits. And that, to my mind, is likely to put some pressure on NIMs going forward. Not that the banks can't handle it, but in my view, we are, maybe another quarter of good NIMs, and then I think NIMs will peak out as deposit rate starts to go up. Most of the banks are running very tight loan-to-deposit ratios, and that's where the public sector banks have a little bit of an edge, because they typically tend to have great deposit franchises, right? And that's being reflected in the current valuation. So I think while banking continues to be a great sector to remain invested in, but I think investors just have to be careful that some banks will see a contraction in NIMs going forward as the fight for deposits starts.
Okay.
Hiren, sorry, go ahead.
Yeah, morning, Hiren. Wanted to ask you about the other big sector, that's the IT space. been a big underperformer this year. However, in the last month or so, there has been select buying that we've seen in a couple of these names. What's your view on the space at this point of time? Because the global environment is still in a tizzy. Would you start chipping in there or would you still stay away?
I think tech sector has always been a great sector for investors. What happened was that the fears of a recession in the US got priced in very quickly in the tech sector this year. And we already seen a significant correction in most of the IT services companies, especially the large caps, right? And while there could still be client level issues, given what we are seeing in the US, and some of the big mega tech companies in the US have not shown very great results. They are cutting back on spending, and many of their revenue streams are also discretionary, right? So you will see that companies there are cutting on ad spending on YouTube and Instagram and stuff like that. So while there might be a few sectors or company level client issues, but on the whole, I think that the worst has been priced into the tech sector. And I think in a couple of quarters, you will start to see tech starting to perform again. Also, mind you that there is, the supply side issues in tech are getting now slowly resolved as manpower pressures go away. And you also have the tailwind of currency, which will also come in and help the margins next year. So even this year, this quarter itself, if you see, quite a few companies have shown reasonably good margins, even as top line has slowed. But none of them are complaining in terms of either order values or order books or pipelines. So I think the tech sector is fine. It went through a soft patch, which was to be expected from a high base. But I think now, there is value emerging in tech as well.
Okay, point taken. But if I want to develop the point that Nigel started off with. Meta and even Alphabet warned that they will not hire, but actually lay off. We could expect slower hiring in India as well. Now, what are the avoid sectors, therefore? Because of lower hiring or recession in our export destination countries, like say Europe or in the Western Hemisphere, are there avoid sectors?
So I think it's difficult to get one-to-one correlation between what's happening in the US and where it could impact Indian companies. As I said, that there could be a one-off impact in a few clients or a few client segments for exporters from India. But I don't think that it is because of what's happening in the US, tech or any other sector should be avoided. And Lata, if you look at the trend of the last couple of years, whenever there has been a slowdown in the US, after the first few quarters, Indian companies have actually increased their market share, because as US companies start to cut costs, they tend to outsource more. And that's usually to the benefit of Indian IT services companies, right? So I don't think that it's such a bad news. US is getting what they wanted. They are tightening, they're raising rates, and they want the economy to slow down to bring inflation down. And that's exactly...
Hiren, 1 minute. I'm not talking about the IT sector. What I'm saying is that because of global slowdown or Western Hemisphere slowdown, even Africa is in trouble. We could have an export slowdown. In fact, it's already showing in the numbers our exports are plateauing. Can there be, lower demand for certain things? We do already have a bit of a rural slowdown in India. Like staples. Can there be sectors like that which could get affected because of, multiplier effect of some kind of slowdown globally?
Absolutely. I mean, it's quite possible. We're seeing that in the two-wheeler exports also, right, Lata? I mean, in the sense that if you look at the numbers from Bajaj or TVS, we are seeing a slowdown because some of the African markets have had problems with Forex and slowing down of demand there. So I think that where sectors have a significant exports, there will be some impact for sure. How long will it last? It's a guess. But I think for the time being, I think, Indian demand-facing sectors are likely to do phenomenally well. You could see some softness, whether in autos or companies which are supplying into some of these end markets might see a slowdown in exports. That's very much possible.
Okay. Well, the market is still holding. Nifty is still up over 100 points, but it's not building on to its gains in any way. The Bank Nifty also, after 300-point bump up, has just stabilized around the 280, 290 points higher. Hiren, there are so many spaces that have come out of the woodworks, this year, whether it's something like defense, renewable energy, or electric vehicle plays. In defense particularly, I mean, even as we speak, something like a Bharat Dynamics is surging. Is there still more scope here?
So yes, Sonia, I think what's happening is that finally, what we've been expecting for many, many years, that defense manufacturing will take off in India, is beginning to happen. And what happens in the early stages of the cycle is that even before earnings start to go up, the PE multiples of this sector tend to expand. And that's what the market is discounting, that they're discounting that over the next few years, these companies will see bulging order books, because more and more stuff is going to be manufactured in India. There is a very, very clear policy shift that is happening, where the government is very clear that they want more defense to be manufactured in India, not just for India as well. In some areas, we are even looking at exports, and we've started to see that. So I think the market's re-rating the sector. And what you're seeing is a PE multiple expansion in the defense sector across the board. And we will see a follow-through in terms of earnings growth as well. We are already seeing that when you look at the order books of many of these companies. And that's what is getting reflected, in my view.
Okay. Well, we'll have to leave it at that. It was a pleasure speaking with you, Hiren, and thank you for ushering the Samvat 2079 conversation by saying that new highs are round the corner. Have a great Samvat yourself. Okay, with that, we turn to the one bank number which absolutely wowed the market. And let me tell you a secret here. We have our banking in-house expert, Abhishek, who writes the key points, key takeaways from the results. And the title of his slug had 8 wows. I mean, he was taking NIMs, he was taking slippages, so many things. And there are 8 wows in his report, indicating that the numbers were such a solid set. Let us invite Amitabh Chaudhary, the CEO and Managing Director of Axis Bank, to tell us more about the numbers. Amitabh, good morning, and thank you very much for joining us. Greetings for Diwali and congratulations for your numbers. I'm going to ask you the negative questions only because everyone knows the positives. The stock price is telling you that. Deposits, that's one growth which we would worry about, and the banking sector liquidity also is drying up. So do you think that you will have to hike deposit rates quickly, and therefore your NIMs could be impacted as early as next quarter?
Well, Lata, firstly, thanks a lot for inviting me to the show. Sincerely appreciate it. It's always a pleasure to come here. You're absolutely right that, yes, the story on the deposit side for the entire banking system seems to be indicating that there is a clear systemic issue with liquidity being low. So every bank is scrambling for deposits. For Axis Bank, as we go deeper, there are some pockets of further improvement, which we are working on, because what we're really trying to do in Axis is to change the dynamics of how do we present ourselves in the marketplace, what kind of deposits we raise, how granular they are, what is the level of premiumization, do we have the presence in the deeper and the rural markets of the country, and so on and so forth. So it is a multi-year story which we're working on. But I'm glad to say that we have already unlocked deposit growth, and we should be able to sustain and accelerate the same. We have been working on various projects internally within the bank to not just go about managing the deposit growth quarter on quarter, but looking at a multi-year strategy and seeing how over a period of time the deposit growth, the level of deposit growth needs to pick up way over what the industry growths are. So if you look at, for example, Axis Bank, the growth across granular deposits continue to be faster and higher than the industry. We continue to gain district level market share. Number of districts where our market share is now greater than 5% has improved by nearly 35% since March 2020. Our premium segment is growing at a much faster pace. And, we have seen an increase in our premium deposits by 220 basis points year on year. Even on the term deposit side, while our rate of growth is slower, it is partly driven by the fact that we want to get our NIMs right. We're also focused on, the outflow on deposits. So we don't want deposits where the outflow ratios are higher. So there are multiple things which we are working on. We do believe that, yes, the next 12 to 18 months would be tough for the industry. And obviously, we are very much a part of the industry. It'll be tough for us. But given all the work which we've been doing, we should come out stronger, better. You mentioned the fact that do we expect to see NIMs getting impacted because of increase in deposit rates? Yes, repricing of deposits or the timing of repricing of assets and liabilities is different. You could see a bit of up and down across the industry in terms of NIMs because of this mismatch in timing. And yes, a lot of the liabilities are still to be repriced. You're also seeing that in the market because of tight liquidity on the incremental borrowing, the rates have gone up way above, what a reverse repo hike would tell you. So all of us, all the banks, including Axis, are obviously trying to ensure that when we have worked so hard to get our NIM in a certain zone, we keep it there and sustain it there. It is not a one-time wonder which we've been working towards. I think the entire strategy of Axis over the last couple of years has been to build a sustainable franchise, sustainable P&L. So we don't want to get caught up in this one-time improvement and then, have a situation where, again, next quarter we have a problem. But yes, it is a problem we have to deal with. The fact that the rate of deposits or the rate of interest on deposits is going up.
Okay, all right. Good morning, Mr. Chaudhary. Going by all that you said, your NIMs, what should be the range then? You expect it to hold around 4%? And also, if you could give us some color on your loan growth, loan book growth. We had a couple of bankers earlier today who are indicating that corporate India, again, they are borrowing. And also the project loans are picking up. Do you echo that?
Well, let me first address the NIM situation first. As we pointed out in our analyst call, we had a distance to cover in our NIMs in comparison to some of our peers. And I think I'm glad to say that as a bank, the translation of what we want to do, which is our intent, to what we are able to achieve, which is the outcome, I think has gone up significantly. So in that sense, we are executing much better. And that is reflected in the kind of growth in NIMs which we saw. And initially, when you start work on a large transformation, you see an additive impact, but over a period of time, you see the multiplier effect coming through. And I'm glad to say that our consistency, reliability, and performance is improving. As far as NIM is concerned and where it will end up, my view is that while we don't give a guidance on margin, we have always talked about the fact that what we're trying to do in Axis is to build a sustainable franchise, which means that behind delivering this NIM is a real story and real work which has been done, and the idea is to sustain it. So we had promised to the market that we are working towards structurally sustainable NIM to reach 3.8. We have reached 3.96. We continue to optimize our balance sheet on both asset and liability side. And so what I'm really trying to tell you is that I'm giving you enough to say we should be in the same zone. And hopefully not only be in the same zone, we should be able to sustain it over a long period of time. As far as the loan growth is concerned, my view is that while opportunities exist, they come at a certain price. So we have to obviously balance our ambition on growth with what kind of pricing we are willing to live with. On the corporate side, you're seeing some small green shoots in terms of corporates announcing large projects. They're looking at borrowing more money. Also, as the interest rates globally have gone up, people are shifting more towards borrowing in Indian rupees. So you're seeing some of those green shoots appear, but is it large enough to have a positive impact on pricing? I'm not seeing that as yet on the corporate side. The retail side continues to see pretty decent momentum. So the combination is that on the wholesale side, the pricing remains tough. On the retail side, things continue to show good momentum. And I think that's what you will see in the quarters to come.
Okay. Mr. Chaudhary, good morning. Happy Diwali to you. I wanted to know a little bit on what's happening with the latest on the Max Financial issue. Is the whole, SEBI investigation over now? Or sorry, the MF issue. Is the whole SEBI investigation over now? And have you heard anything from the regulator?
So as we had told the market consistently that we had done our own internal investigation, SEBI had also requested us to go and do some very specific checks, which we have done. We have completed those investigations. We have submitted the report to SEBI. SEBI has asked us some more questions. We have replied to them, and we are in the process of answering all those questions. In our investigations, we have not discovered much. And whatever we have discovered, and we have seen any signs of people doing things which we are not permitted to do, we have taken action. Okay. But we are still await SEBI's direction in terms of what the next steps would be. We are obviously very committed to cooperating with the regulator and taking all the steps necessary to ensure and comfort the regulator and the market that our intention is right. We will do whatever it takes to ensure that an issue of this nature is never repeated again. But let me just end by saying that we are still awaiting instructions from SEBI, and our investigations have really not shown or brought up anything even remotely close to what the speculation I've seen in the marketplace.
Okay. All right, then let me ask the Max question, Amitabh. Well, you know, the IRDAI order was very clear. Max can't, sell to you at 166 on March 15th and buy from you at 31 rupees the next day. So they're not going to let you do the second leg at that lower price. Will you be willing to increase that price? Are you willing to go to 100 rupees or 150 to buy that remaining stake in Max?
So let me first start by saying that the transactions which were undertaken, which we have just talked about, 2 transactions, they're part of 2 separate agreements. And so one transaction was under one agreement, which got closed, and then a second agreement was initiated. We believe whatever we did, and there were a lot of parties involved, was absolutely as per the book. Enough lawyers have looked at it. Obviously, our regulator, IRDA, has a different view on how the transactions were undertaken. We believe we had all the permissions from IRDA for the same. Our view of the industry is very, very long term. We know that we would like to continue to work with the regulator. So we will obviously like to ensure that we are in line with what the thinking of the regulator is. As far as we are concerned, while the order talks about some of the transactions and why they have fined us, I am not very clear at this stage that IRDA will not allow X, Y, Z. Let it pan out. Let's see what happens. And depending on what the IRDA directs us, we will take a call at that time. It's very wrong on our part to kind of start speculating that this is what IRDA does, this is what our reaction would be. Our commitment to Max partnership remains. We are committed to, obviously, if everything permits, to continue to grow the size of our equity shareholding in the entity, and obviously continue to work with Max in the long run. But yes, let's wait and see how the next steps pan out over a period of time.
No. The more direct question is, will you be willing to pay more for the balance 7% stake?
And I gave a direct answer, Lata. I said that let the time come and then we'll decide at that stage.
Okay, it's open now. Well, when you look at the set of rates which IRDA, set of trades that IRDA has put in its order, it does look like a severe indictment that the trades are done at such different levels on subsequent days. So, did SEBI or anyone else, any of the other regulators, SEBI, RBI, speak to you on the matter or write to you on the matter?
No, we have not heard anything from SEBI or RBI in that matter. Again, as I said, these are transactions which are part of 2 separate agreements.
Okay.
And the first agreement, where the shares have been sold at a certain rate, it also allowed us to sell another set of shares, which we extinguished. So we gave something up in that particular transaction. Then we signed another agreement under which certain, buying of shares at a certain price happened. I mean, I don't want to go into details of the transaction. We have spent a long period of time to consummate the transaction, and obviously through the whole process, number of conversations have happened with IRDA, a number of documents have been shared with IRDA, and that's why I'm saying that we believe that we have done everything by the book. Obviously, regulator has a view, and we honor that view, and we are not standing here and saying that regulator is wrong. I'm just saying that we believe we did everything right. Regulator has a different view. We are working with them to ensure that we can find the right solution. I think it would be wrong on my part to start speculating on what that solution is.
Fair enough. Okay. Also, it looks like IRDA doesn't want an insurance company to merge with a finance company. So this Max Finance, Max Life, union consolidation can also be impacted. Will that impact your relation with Max Life?
Well, that is something which Max Financial Services and Max Life do need to sort out over a period of time. Our investment is in Max Life. Our intention and desire is that Max Life gets listed at some stage. Obviously, it has an implication on the Max Financial Services shareholders. So I'm quite confident that again, Max Life and Max Financial Services is working with the regulator. There was a stance which the regulator took many years back when HDFC and Max Life were trying to, merge. There was a stance was based on a certain opinion. Again, rather than speculating, I've told you what the desire of Axis Bank is. Again, let's see how over a period of time this pans out. But at some stage, we are quite clear that it will be best for everyone that Max Life does get listed.
Okay, Mr. Chaudhary, I wanted to come back to the loan growth, because this is a very peculiar time, right? I mean, it's the highest loan growth that we've seen in the last 10 years for the industry as a whole, 18-20%. You being one of the biggest banks in the country, do you think that this is a sustainable run rate that perhaps through the course of the year, or is it largely because of pent-up demand? Corporate capex is now coming back after a very long time. What do you think the average loan growth could be for the industry, and particularly for corporate as well? Is it more working capital loans that are still being taken, or is it fresh project loans that are being executed?
See, at a macro level, for the loan growth to sustain at this level, given where the deposit growth is not possible. You cannot have a situation where deposits are growing in a single-digit rate and the loan growth is, racing ahead at 18-20%. Actually, loan growth needs to follow the deposit growth.
Yeah.
So yes, there is a temporary period where you are seeing this mismatch. It is, as I said, on the retail side, the momentum is quite solid and it continues. On the wholesale side, I think it is driven more by refinancing. I do not think that you are really seeing huge amounts of private capex coming through at this stage, which is driving loan growth demand. The hope is that will happen, but it is not really fructified on the ground as yet. Please also appreciate that a lot of deleveraging of the corporate sector has also happened over the last couple of years. So a lot of these corporates are actually in a very good situation and they can fund their capex growth, at least the small capex growth they're looking at on their own rather than going and really borrowing in the market. So yes, on one side, while I'm saying that there is still some hopefully increase in loan growth which could come from the corporate sector because you're not seeing enough capex happen as yet. The macro factors playing out globally could have an impact in India because with the rising interest rates, you could have, obviously the regulator is also trying to reduce the inflation and working on inflation, and obviously they're doing various things to manage inflation. You could see a damping of demand on the loan growth side. You could see a deterioration of asset quality as a result also. So there are too many factors at play to really say today that, oh, no, we are very sure that the loan growth will continue at this rate.
Fair enough.
It's a very volatile market, too dynamic. But right now, standing where I am, I think for the next couple of quarters, the loan growth should continue at similar rates, given some of the trends that you're seeing.
Okay, can you leave us with just one last number? I told you the 8 wows that Abhishek Kothari came up with. One of them was for the fall in the cost to income. That's what it's a 2-year low or something. Do you have a target that's entirely in your hands? So from 46.5, is it now 46% now? Any target for the year, for next year?
So we have been guiding the market to not to cost to revenue, but more cost to assets of below 2%. And that's what we are very clearly focused on. We do believe that there's something which we'll be able to get to in the medium term. We have been investing a lot of money on our technology, analytics, transformation projects. The impact of some of those projects has started coming through. So the productivity lift is allowing us to show a higher revenue growth rate and get the right kind of operating jaws in the business. I'm glad to see and hear about the 8 wows. Hopefully, the number of wows can continue going forward in the future. But I mean, it's a long haul. It's a tough haul. And I think all of us in Axis and the entire management team of Axis is very focused in terms of delivering on the GPS strategy, which we talked about 3 years back.
Yes.
I'm delighted that this quarter surprised people. I hope we can do more going forward in the future.
All right. Very quickly, sir, before we let you go, any plans to raise some funds post the closure of the Citi acquisition?
I think we have been quite clear in terms of what we said in the analyst call. We have a very comfortable capital position. Again, depending, where we stand today, there is absolutely no intention to raise any capital till the Citi acquisition is done. We will look at the right timing and we will look at the right price, and we will look at the fact that our existing shareholders don't get diluted unnecessarily. And moreover, the performance we are delivering, we are also seeing a situation where our current level of profitability is good enough to fund the growth of the Axis Bank business. So I'm kind of giving two parts to the, there are two parts to the answer. One, no intention to raise capital till the Citi acquisition is done. Secondly, post that acquisition also, we'll bide our time and do it at the right time, which makes the best sense for us and our shareholders rather than do it in a hurry. So that's
Any worries at all about the Citibank card holders signing off, and therefore you want to negotiate a lower price?
Well, we have a deal. In our valuation model, when we priced the deal, we had obviously taken some attrition into account across their businesses, not only on the credit card side. We obviously are getting the business metrics on a monthly basis. And right now, when you look at the data, there is nothing which is worrying us. Yes, there is some attrition, but it's not to the extent which people are speculating about. We also had a kind of a backstop that below a certain level of performance, there will be impact on valuation. Right now, we are nowhere even close to it. So in that sense, things are going well. And we do believe that we should be able to close the acquisition either in the first quarter of the next calendar year or in the second quarter.
Got that.
I mean, obviously, with the year end coming in, you either want to do it just, reasonably before the year end or then, push it beyond year.
Fair enough. Fair enough. Thank you very much, Amitabh Chaudhary, for joining us with all those details. Congratulations for a great quarter, and here's wishing many more.
Thank you. Thanks, and wishing you happy Diwali to all of you.
Okay, we have to take a break, and thereafter we're going to get you an exclusive conversation with TV Narendran, Managing Director and CEO of Tata Steel, on their UK business going ahead. We will also be joined thereafter by Anuj Puri of Anarok and Gulam Zia of Knight Frank to talk about demand trends in the real estate space this festive season.
Co-powered by